Here we go. For example, let's say we've got a current account or an instant access deposit. MTA means money transfer account, so a current account, where due to from all the analysis we've done up to now, we've assigned a 5-year behavioral tenor, but current accounts have a floating rate, interest rate, they're not fixed. A lot of current accounts pay 0 anyway. So all the notional balances received for that product in this month are paid by the FTP function, the 5-year TLP, which we work out and estimate. So the funds transfer price will be my short-term funding rate plus the 5-year TLP paid on that notional balance at the end of the month. I write a monthly ticket. Funds transfer pricing for a banking book is not a daily ticket per transaction. You can imagine it's a once a month, say month-end ticket for all the balances raised or lent for that product in that month. Let's have the next example. I've got a 2-year standby liquidity facility. Now, for the regulatory purposes, depending on who the customer is, I make some assumptions about it being drawn down to max straight away, the maximum amount straight away, and for the full term. So in this case, the FTP is the short-term funding rate plus the 2-year TLP on a floating basis, because the interest rate charged to the customer is the overdraft rate, and that's not fixed. So that would be a floating rate FTP. Then I've got the other example, which I think I mentioned just in slide 24 anyway, 25-year legal maturity residential mortgage, contractual maturity, but the customer has taken out a 3-year fixed rate on it, so therefore I give the fixed rate 3-year FTP. After 3 years, I'll reprice. I have the repricing option, so of course I will rewrite the FTP ticket. So what a bank will need to do is have this description for each of its product types in its funding policies, so that the business line knows how FTP is applied. Okay, methodologies for establishing the TLP component of the FTP rate. What is the TLP component? You should look at the market swap rate and then work out what you're paying above that, but then try to strip out what your credit premium of that is. The credit premium may be 0, of course, if you're raising very cheap funding, and then that is your TLP. I did mention, if you just go back to slide 24, if you look at slide 24, I've got there a note about competitor rates also influencing your FTP. That's quite right. At the end of the day, we've got to be competitive with our peer banks, our competitors, on their loan and deposit rates. If our FTP mechanism or calculation is showing a customer pricing that is not competitive, we will have to do some adjustment. Either we don't have any competitive advantage in that product, or we need to artificially adjust the FTP rate to ensure we are being competitive. But then that has implications for to what extent you are covering the cost of your liquidity premium. So what is the TLP? There are some market proxies we can take. A very good one is looking at your conventional swap curve compared to your overnight index swap curve. Not every currency, not every jurisdiction has that reference. So you might want to take the Eurobond curve for your government's foreign currency borrowing. So in other words, the foreign currency, the dollar sovereign bond curve against the dollar curve, the risk-free rate. That's a TLP as well, but that incorporates your government's credit premium, your sovereign credit premium. But of course, the sovereign, if we follow Moody's and S&P logic, is always the highest rated borrower in any country jurisdiction. So your bank will have a higher credit premium than your sovereign. So that's, again, a proxy to take for your TLP. So we want to estimate term liquidity premium. Of course, if we are in the habit of simply taking our cost of funds above the market reference, above the swap rate, and making that the TLP, I don't need to worry about stripping out the credit premium.